In this lecture, what I want to do is continue in Chapter 11 talking about how depreciation is used on tax returns for businesses. In the previous lecture, we talked about various classical methods of depreciating assets, including straight-line depreciation, sum of years digits, and double declining balance. If you have not already seen that, please go back and watch the recording from the last day of class. This lecture will pick up talking about bonus depreciation. So let's get into the material here, and we're going to talk about bonus depreciation, which is a relatively new concept. It's been around for about 20 years. And what this allows us to do is to immediately expense some of an asset's cost. So if you remember in our previous lecture, we talked about how depreciable assets are capital assets which normally take several years to consume. So things like purchasing a vehicle, purchasing real estate, all those kind of things, you don't expect that that vehicle is going to be completely used up in its first year that it's in service. And so what the government typically allows you to do is to depreciate that asset over time based upon its expected useful life. And we saw various methods for doing depreciation, but one thing to talk about here is what's known as bonus depreciation. And so what bonus depreciation allows you to do is use some portion, even as high as 100% of the cost basis of that asset, as though it were a regular business expense that could be expensed on a tax return in the very first year it was in service. We are currently in a period where 100% bonus depreciation is the norm. So this is very advantageous to companies because what it allows them to do is purchase a capital asset and immediately write off the entire value of that asset on their tax return. Typically, however, the bonus depreciation is less than 100%. You only get to do a partial bonus depreciation. And so if you do have such a depreciation that is less than 100%, then you will have to use other methods. Specifically, with the current tax code in the United States, it would be the MACRS, which is the Modified Accelerated Cost Recovery System. And in this lecture, we will get into many details regarding that. So this slide right here gives us a little bit of the history of bonus depreciation and the amount that you can take off. And one thing that has happened in years past, so in 2010 through 2012, we were all the way up to a 100% bonus depreciation period. And you'll also notice with the Tax Cuts and Jobs Act that happened in 2017, in 2018, we went into a period of 100% bonus depreciation. And we are currently in that, expected to drop off here in 2023 back down to 80%. Now, what this timeline shows is historic bonus depreciation, and then it also in the dashed lines has some forecasted bonus depreciation. So your textbook was written in 2020 with the most up-to-date information that was available last year. I can tell you that in 2021, we are still in this 100% bonus depreciation. However, with the way the Tax Cuts and Jobs Act was written, there is a sunset period for this. Now, this is not to say that this is actually what will play out. So if the Congress sees fit to continue 100% bonus depreciation for businesses, then we could keep that in the coming future. Now, with the current Congress the way it is, that may not be entirely likely, but we'll see what actually happens. But for right now, we are in a period that is very advantageous to businesses where 100% of the assets they put into place with their business can actually be deducted in that first year in use. So, we did make mention of the Tax Cuts and Jobs Act, and this is one thing that I like about your textbook is it has very up-to-date information on the most recent changes to the tax code. This did expand bonus depreciation from the period 2018 through 2022 all the way up to 100%. But as we had mentioned, there is a planned phase out where in 2023 it goes to 80%. And you can see on the screen by 2027, bonus depreciation, unless there is something that changes in Congress, bonus depreciation will go away. One other thing that was expanded by the Tax Cuts and Jobs Act is what's known as Section 179. And Section 179 applies to small businesses So there is a certain amount of expenditure limitation for a business to be considered small for Section 179 purposes. And so once a business goes above, I think it's about $3 million in expenses for a year, they no longer qualify for Section 179. But if a business is small enough that their expenses are under that threshold limit, Section 179 was expanded to allow the expensing completely up to $1 million in the year of purchase. And actually in 2021, that has been slightly expanded further to $1,050,000. So we'll see some examples of where Section 179 comes in. We'll see some examples of bonus depreciation, and then we'll see what to do with the leftover amounts if we were in a year that did not have 100% bonus depreciation. So, getting right on into that, the first example here is example 11-4 from your textbook. And this says you have an asset that had a cost basis of $80,000, salvage value of $20,000. How much bonus depreciation is going to be allowed in each of the following years? So A was 2015, B 2019, C 2023, and D 2027. If you were to go back and look at the timeline chart that I had showed previously, in 2015 we were in a period where the bonus depreciation that was allowed on your tax return was only 50% compared to now at 100%. So if you were trying to do this bonus depreciation for tax year 2015, you would only be allowed to count 50%. So 50% of your $80,000 asset gets you a bonus depreciation of $40,000. Now keep in mind, for other depreciation models we have used, we have considered the salvage value. Within this model, we are not having to consider the salvage value at all. So it's completely irrelevant, the $20,000 salvage, to what we get for bonus depreciation. In year 2019, that was during the period after the Tax Cuts and Jobs Act, great time right now where we're getting 100% bonus depreciation, so we get to take off all 80. And by 2023, that's the beginning of the sunset period on that bonus depreciation. That's when it goes back down to 80%. So 80% of $80,000 is $64,000 in bonus depreciation. And then if you stretch this all the way out to Part D, which is 2027, that is after bonus depreciation is forecasted to go away. So we anticipate that in 2027 we won't have bonus depreciation. However, again, it's up to what Congress decides to do, whether they decide to extend these provisions of the tax cut or not. Now, let's look into some examples. So example 11-5, suppose you did have 100% bonus depreciation. Let's suppose you had something that had a 5-year depreciable life, would normally be in a 5-year category for the MACRS, which we'll talk in detail about in a few minutes. And it was a $900,000 asset with a $70,000 salvage value. Well, because we are in a 100% bonus depreciation, you immediately get to depreciate it $900,000 in year 1, and that means over years 2 through 5, it does not have any further depreciation. It's already been depreciated by 100% in the very first year. Now, moving on to something a little bit more complicated is what is known as recapturing depreciation. So, what we have here is if you depreciate an asset and it actually gets depreciated to less than the fair market value for that asset, and you do go to sell it at the fair market value, now you have a difference between what's known as its book value, that is the amount that's left over of the original basis in cost, based upon having taken off the allowable depreciation in every year. So let's look at an example here. Let's suppose that you depreciated a $10,000 asset with 100% bonus depreciation. So immediately in year 1, it's depreciated all the way down to 0. It's going to stay there. And now we go to dispose of the asset 5 years after operation. And so we have different values that we could get for a salvage. The first case is we get paid $7,000. So we can salvage this, sell it to maybe another company for $7,000. Under this case, we are having to recapture depreciation. So the fact that we had depreciated something all the way down to 0 and its fair market value was actually above that, that means that we would have to pay the tax on that added $7,000 in income, because that would be considered a gain above the $0 book value that we currently have. In option B here, we had depreciated it down to zero. We got no salvage for it. We basically just threw this away or scrapped it. And so in that case, no recaptured depreciation, no gains or losses, and we're even. However, there are some disposals where you actually have to pay some money to get something disposed of. Maybe it has some hazardous materials. Maybe it requires some sort of deconstruction or some sort of an expert to uninstall this. And so in this case, it's going to cost you $2,000 to actually get this item removed. And so in this case, the book value is zero, and now you're having to spend $2,000. So now you're into sort of a negative amount there. You have a negative value on it. And so you actually get to deduct that $2,000 as a loss. Now let's get into the MACRS, and typically what we're going to use is what's known as the General Depreciation System. And this is based upon the declining balance model and straight line depreciation. It's going to start with the declining balance model, but once we get to a point where straight line depreciation is actually more advantageous, it will switch over to straight line depreciation. One thing that is unique about the MACRS is it actually uses property class lives to determine the recover period. So you may think that a certain item that you purchase, capital equipment, things like that, might have a certain useful life. And depending upon what model you get, you might have one that's more durable, one that's less durable. And so you might expect that there is a variation in useful lives. But what the MACRS does is it sets up a particular property class for every item. So if you're buying office furniture, that is denoted in one of the property classes, as we'll see shortly. Now, if you buy a premium chair that is really durable and very nice, you would expect that it would last longer than if you bought the Walmart special that was super cheap. And so in those cases, you would expect their useful lives to be different, but from the government standpoint, the property class life is the same, no matter whether you got a $10 chair or you got a $10,000 chair. The other thing is with the MACRS, the salvage value is assumed to be zero, so after the particular number of years that pass based upon the property class life, you are assumed to have a book value of zero. That may require some recapture of depreciation if you are actually able to salvage it beyond the useful life that is forecast by the government. We'll also talk about some examples of what happens if you salvage something before it's fully depreciated. And what we'll also see is that there are tables which simply list out the percentage of the basis that you're allowed to deduct in any given year when you depreciate an asset. So, getting into the method of actually applying this, what we need to know is, first of all, what is the asset's cost basis? Now, simply that is typically how much you pay for an item. However, there may be some extra fees or charges associated with getting that item into service. So, for example, if you bought some capital equipment, but then you had to pay somebody to actually install that equipment, your cost basis would be the installation cost plus the cost of the actual equipment. If you had to pay certain fees in order to get things, let's say there was a permitting fee and those types of things, some of those may be able to be added to the cost basis. So you would have to check the rules in the tax code at the time just to make sure that we are including certain things. So if you bought an item and then you painted it before you put it onto a shop floor, you might be able to add the cost of the paint to the actual purchase price of the item. Now, once you've determined your basis, now you need to determine what property class that item is in. And so you can see the property classes in Table 11-1 in your textbook, or the IRS actually has these in tables. And then what you're going to use is the recovery period that is associated with that class. And we'll see several examples of that as we go on. Now, if a particular item is not listed in any of the property classes, the default year of recovery or amount of recovery time is going to be 7 years. So we will use the 7-year class if that particular item is not covered by various other asset classes. So let's see some examples of the different property classes. The shortest property classes, those are things that are devices for food and beverage manufacturing, tools for the manufacture of finished plastic products, metal fabrication, and motor vehicles. This is not the vehicle itself, but just the actual special tools that are used in the manufacturing there. Now, 5-year classes, this is where cars and trucks start coming in. However, cars and trucks have their own special rules that limit how much you can depreciate in any given tax year. And then here you also see things like aircraft, computers, petroleum drilling equipment. 7-year property period is where furniture comes into play, office furniture, fixtures, equipment, things like that. And that's also the default if you don't see your particular item in any other property class. Getting into longer than 7 years, you've got things associated with petroleum refining and water transportation that are 10-year class things. For 15 years, this is where you get into sewage treatment plants and telephone distribution plants. 20-year is the sewer itself. And then real estate actually has really long property class. So if you're talking about residential rental property, now the key word here is this has to be residential and it has to be rental property, and that does not include hotels and motels, which would be considered commercial property that is rented out on a short-term basis. So residential rental property, these would be things like duplexes that are rented out for income purposes, things like apartment complex buildings and those types of things. It is important to note that you can only use depreciation on those types of properties if they are used in making money as a business venture. So if you just happen to buy a beach house and your buddy happens to pay you $500 one time to go use it for the weekend, that's not considered business use. So in this case, this is something that has to be put into service, used for the purposes of making money on a pretty regular basis. Then you have non-residential real property, so this is typically commercial type property, and that has the longest property class of them all at 39 years. So if we were in class, I would give you a top hat question. What is the cost recovery period for a computer? So you go back and you can look here and you see that computers are in a 5-year property class. Now, that doesn't mean that your computer is necessarily going to last 5 years. You might have a computer that only lasts 3 years. You might have a computer that lasts 7 years. But on average, you get to depreciate it over a 5-year period, assuming you don't have 100% bonus depreciation. So the correct answer there is 5 years. Now, getting into some of our notation that we will be using throughout the rest of this lecture, DT is the depreciation deduction for your taxes that could be written off in year T. Then you have B, which is your cost basis. That is your basis for the asset, so potentially the purchase price, plus any fees or costs that you had for getting it into service. And then you had RT, which is the rate that comes from the MACRS percentage rate. So again, if you're talking about calculating the basis, let's say you bought a house and you're getting ready to rent it out, but then you had to pay a contractor, maybe you got some new flooring put in or things like that. That steps up your basis, the fact that you put money into getting that asset ready to be used for business purposes. So major expenses like that, like buying a new roof, buying new flooring, upgrading the plumbing, all those kind of things can add to your basis. Here is the MACRS percentage rate tables. So this shows you what percentage you can actually deduct in any given year. Now, this starts with the double declining balance method, but one thing to note is in the first year and in the last year, you only get to deduct half of what you would normally get to deduct. So as an example there, in the 3-year class, if you use double declining balance, you would have 2 over n, where n is the number of years, or the number of years in the useful life. That would be what you would normally get to multiply by the cost basis from the previous year. So if you did n here as being 3, 2 over n would be 2/3. However, because this is the very first year, we're only allowed to use half of that. And so we only get to deduct 33 1/3% in year 1. Whereas in year 2, we get to deduct 2 over n times the basis that is remaining. So if you were to actually do this out on a calculator to figure out this would be 2 over n, 2/3 times 100% minus the 33 1/3% that was already deducted off of there. And what you would get is a 44.45% deduction there. So now at this point, what happens is that you end up having straight line depreciation take over because you get down to the point where straight line actually does better than the double declining balance. And so you get to 14.81, which would be the percentage that would remain as the deduction until the very last year, which you just get half. So here you can see switching to straight line depreciation, and then you get down to half of it in the last year. One other thing to note is up here in these longer classes, instead of double declining balance, they actually get 150% declining balance. So instead of 2 over n, they just get 1.5 over n. And then, of course, they also still have the half-year convention in year 1 and in the last year. So this we'll get into in the next few slides exactly how those percentages were calculated. But what you just need to know is that for the classes that are 3, 5, 7, and 10 years, you do use the double declining balance. That's 200%, or the 2 over n. 15 and 20, as I just mentioned, has 150% declining balance, so that's where you get 1.5 over n. And then the asterisk in there denotes when straight line depreciation takes over. We'll see an example of that on the next slide. And then you also have the half-year depreciation model in the first and the last years. And again, we're assuming no salvage value at all. So in this slide, we will actually see where some of those MACRS rates come from. This is using a 5-year class. Our basis is going to be considered 100% of whatever the cost is here, no salvage, and we're again using the half-year convention for the first and the last year. So if we did double declining balance, because this is a 5-year class, so we get 200%, we get 2 over n. Now our number of years is 5 years, so we get 2 over n would be 5. 2 over 5 times 100% would normally be 40%, but again, this is year 1, so we get 1/2 of that. So if you use double declining balance and the half year in the first year, half in the first year convention, then we get a 20% deduction. However, if we went to straight line depreciation, we would say let's take that 100% divided over 5 even years, but then we only get half of that, so this is 20% times half. We would only get to take 10%. So in this case, we say, hey, 20% deduction is better than a 10% deduction. Let's go ahead and take the 20%. And over here, this is our cumulative depreciation that we have thus far. So the first year, this is the first time we've done any depreciation. So cumulatively, we've taken off 20%. Now what that means is we've got 80% of our original basis left over. So our book value is now down to 80% of that original amount. And so down here, we go to, again, 2 over 5 times that amount. Now we are in year 2, so we don't need to take that 1/2 anymore. So we get 2 over n, 2 over 5 times 80%. And so this is going to be 40% of 80%. And so that works out to 32% if we do the double declining balance. And if you were to do straight line depreciation, notice right here we have 80% left over, and we've got 4.5 years left. So at this point, we took off half of a year because that was in year 1. We used the half-year convention. And then we've got 4.5 years left. So if we take the 80% and divide it evenly over 4.5 years, we would get to deduct right there 17.78%. And if that was better, that would be what would continue until the end of our useful life. However, 32 is much better than 17.78, so we're going to accept the 32 from the double declining balance. We add that to the 20% that we had already deducted, and so now we're up to having deducted 52% using depreciation. Having deducted 52%, that means our basis value, our book value right here, is now down to 48% of its original amount. And so again, we try the double declining balance, 2/5 times 48%. That gets to 19.2%, which is better than 48% divided by the remaining 3.5 years, which would only be 13.7. So once again, we choose the double declining balance percentage. We choose 19.2%. Adding this to the 52 that we already had previously deducted, now we're up to having taken off 71.2% of the original basis. And now we look at this and say, okay, what would be 2/5 of the remaining 28.8? So 100% minus the 71.2 is 28.8. That's how much is left over. And at this point, we actually get a draw to where the straight line calculation and the double declining balance is the same. And this is where we will know that straight line is actually going to take over and be more advantageous from here on out. So in year 5, we don't even worry about computing the double declining balance, and we trust that it will be less than the 11.52, and it will be. So if you just do 2 over 5 times the remaining 17.23%, or sorry, 17.28%, then you are going to see that it is going to be less than 11.52%. So we keep that there. And then in year 6, now we're down to just a half year after the 5-year period is up. And so we get half of the straight line amount, so we get 5.76%. If you add up all of these percentages over this 6-year period, really it's 5 years but spread over 6 tax years, then you do get 100%. So after that, you do have a book value of 0. 100% has been deducted. So now let's see these percentages actually applied to a particular cost basis. So in this case, we have an asset. It's in the 7-year property class. It has a basis of $150,000, and we're going to have a salvage after 10 years of $30,000. So this being in the 7-year property class, we can look up the percentages that we can deduct for 7 years. So that's going to be 2 over 7 in the first case times 1/2. And so we've got that multiplied by 100%. Then we have 2 over 7 times the remaining percent. So that gets us 24.49, etc. And so we multiply those percentages by the original basis of $150,000. And we see over here in the fourth column, how much we can actually depreciate in any given year. And we see the book value go down. So the book value started at $150,000. After the first year, we depreciated it by $21,435. So now we're down to a book value of $128,565. And after the year 8 tax year, that is when everything is depreciated down to 0. Now, if you were to sell this in year 10 for $30,000, you would have to recapture all of that depreciation. So you would have to pay taxes on the full amount of $30,000. Now, let's see some examples of the MACRS using a 3-year asset life, and what would happen if we were to sell something before it was fully depreciated. Well, what actually happens there is the IRS, by rule, does not allow you to take the entire depreciation in the year that you sell it. You can only take half of it. So we use this half-year convention yet again. So in this case, if we can sell this for $5,000 in year 2, that means our market value for the item is $5,000, even though the IRS has allowed us to depreciate it even lower than that. And so our book value at this point, after year 1, is going to be $10,000. That was the initial cost basis right there, minus 10,000 times 0.333, 33.33%. And so that brings us down to a book value of $6,667. Now, if we use the 50% depreciation that we're allowed in year 2, because that's the year that we salvage, we would figure out $10,000, that's the original cost basis, times 44.45%, but we have to divide that by 2 because this is the year that we're salvaging it. We would normally get to take off the full 44.45%. We only get to take off 22.225% in there, and so we actually have a much lower deduction. We only get to take half of it by the rules of the IRS. So now our book value, we take off the amount that's depreciated from our previous book value. So we previously had $6,667. We're going to take away from that the $2,222.50, and that leaves us with a book value of $4,444.50. Now, because we are selling this for more than our book value, that means we had a gain. That means that we have to recapture some of the depreciation that we'd already previously applied. And so in this case, we're going to have to recapture $555.50 because that's how much more we sell the item for. That's how much more its market value is than what it was depreciated to. And so in this case, our total deduction for the year on our taxes, we are going to take 50% of the depreciation. So we do deduct $2,222.50. However, that gets offset by this recaptured depreciation, and so our net deduction is only $1,667. Now, let's suppose we didn't follow the IRS rules and we didn't take any depreciation in year 2. In this case, we sold it for $5,000. Its cost basis coming into that year was $6,667. So that means we had a loss of $1,667 on our sale. And business losses get to be deducted, so we're going to deduct $1,667. Notice that it works out exactly the same as doing 50% depreciation and then working out the depreciation recapture. Finally, let's suppose that the IRS rescinded that rule and we did not have to do 50%. Let's suppose we could take 100% of the MACRS deduction allowance in that particular year, in year 2. And so in that case, we're going to take off 44.45%. And so we had a $10,000 item multiplied by 44.45%. That means we can deduct $4,450. And we take that away from our book value that we had after the previous year, $6,667. And now we're down to a book value of $2,217, which is much less than our market value of $5,000. So what that means is we're going to have to recapture that depreciation, and the amount to recapture is $5,000 minus its current book value. So we have $2,783 of depreciation that needs to be recaptured. And then our total deduction is going to be the amount that we're depreciating minus the amount of recaptured depreciation. So that nets out once again to $1,667. So the main takeaway here is no matter whether you use 50% depreciation, 0% depreciation, or 100% in the year that you are selling it, you actually just have to look at what is the differential between the book value as it exists in that year and the actual amount that you sold it for, and reconcile any depreciation that brought that value, the book value, below the fair market value. All right, moving right along. Now, let's factor in several different things. So we're going to, in this example, look at Section 179 implications, some bonus depreciation, followed up by the MACRS applied to some partial remaining capital costs. So in this case, a company has purchased $1.3 million of 7-year class equipment, and it's going to meet the requirements, the company does, for Section 179. That means it's a small business with some limited expenses, and there's also 60% bonus depreciation in effect. Now what we're going to see is that the Section 179 actually stacks earlier before you get into the bonus depreciation. Then you combine those, and then we'll follow the MACRS with the remaining value. So in this case, the firm is claiming the full $1 million limit. If this were 2021, they would actually get $1,050,000. And so taking that off, the cost basis is now only $300,000 because we immediately are deducting that $1 million. Now, there is bonus depreciation. That's going to be applied to the new cost basis of $300,000. So from that, we get 60% off of the $300,000. So that's an additional $180,000 that we get to take off because of bonus depreciation. And now you will see we were down to a basis of $300,000. We've taken off another $180,000, and so that brings us down to a cost basis of $120,000 moving forward. And so now the MACRS does start to factor in. We're using a 7-year MACRS period, and so we can look at the tables there and see that the first year is a 14.29% deduction. And so we take that off of the $120,000 that was yet to be accounted for with our Section 179 and our bonus depreciation. And that means that we get to add another $17,148 as a depreciation deduction. And the remaining depreciation will use that cost basis, the $120,000 that was left over after the bonus depreciation and the Section 179. And so the total deduction just in year 1, because we're immediately taking that Section 179 claim, we're immediately taking the bonus depreciation, and we're following that up with our year 1. you add up the 1 million plus the 180,000 plus the 17,148, and you get a huge deduction thanks to all of these things in the tax code of $1,197,148. So just after 1 year, you've depreciated almost all of that 1.3 million, almost that 1.2 million that's been depreciated just in year one because of these various tax rules. Looking at a 60% bonus depreciation, let's suppose you had a $900,000 item. We're going to use a 5-year class, and it has a $70,000 salvage value. If we had 60% bonus depreciation, that means that immediately we would write off 60% of the cost basis, or $540,000 immediately, and those would be treated as though they're regular ordinary expenses, can be deducted right there in the first year. So pretty nice big deduction to be able to take off in that first year. So now we've got 40% left over. That's $360,000, and that will go through the 5-year class using the MACRS values here. So we have a cost basis left over of $360,000. Here's the MACRS. That's the percentage value that you can take off of your cost basis in every given year. And so multiplying those through, this is the depreciation that can be taken off in each of those years, 1 through 6. And the cumulative depreciation is just adding up all of the depreciation for this year and any years prior. And finally, the book value at year T is going to be the basis minus the cumulative depreciation that has occurred thus far. Now, if we were to do a similar problem with a 40% bonus depreciation, now we've got a $150,000 asset, 40% of that is $60,000, so you immediately take that off as though it's a regular expense, leaving 60%. 60% of $150,000 works out to $90,000. So you have $90,000 that goes through the MACRS. Here with this 7-year utility class, these are the percentages that you get to take off. And so you see here that your basis is the $90,000 that was left over after we took off the $60,000 here. And so now we have our depreciation in every year, 1 through 8. And our cumulative is just keeping a running sum of all this. And so in this case, we had fully depreciated at the end of year 8, $90,000 of the original $90,000 that we had left over as our basis. And so our book value then goes all the way to 0. This graphic here depicts the difference between straight line depreciation, double declining balance, MACRS, and the 100% bonus depreciation for a 10-year period. So in this case, 100% bonus gets that book value down to 0 immediately after year 1, which is very nice for companies to be able to expense that right away. The MACRS is actually better than double declining balance and straight line depreciation, except up here in year 1 where you have that half-year convention. So you don't get to take quite as much, but the MACRS will actually take the book value down to just about 0 in as efficient a manner as possible, except for when you have this 100% bonus depreciation. Now, the last type of depreciation that I want to talk about is unit of production depreciation. So in this case, this is equipment that loses value based upon effectively how much you use it. So a classic example of that, which is actually in combination with time depreciating it, is the resale value of vehicles. So if you were to take, let's say, a 2010 car to a dealership, they would look at how old it is, but they would also look at your mileage. So depending upon how many miles you drove that car, that is going to determine, in many cases, how much that dealership is going to give you for that car. Now, of course, they're going to look around at other things like, does it have dings and dents? Is anything obviously wrong mechanically? But part of the depreciation is the use of that equipment, the use of that car. That's the case here that we're going to be examining, is where we're looking at the unit of production depreciation in any given year being based upon how much was produced in that year divided by the total lifetime expected production multiplied by our basis minus our salvage value. So here's an example. Let's suppose you have $900,000 equipment that is used in a sand and gravel pit. You're only going to use it for 5 years, and then this sand and gravel pit is going to be completely shut down. We're going to sell all the equipment for $70,000. So that's our salvage value. Our basis value is the $900,000. what we need to do is compute the unit of production depreciation schedule if the project calls for all total 40,000 cubic meters of sand and gravel to be moved. So in this case, we look at, these are the actual amounts of gravel in terms of sand and gravel in terms of cubic meters that were moved in any given year. So in the first year, we used this equipment to move 4,000 cubic meters. In the second year, it went up to 8,000, then 16,000, and you see the pattern decline on down in years 4 and 5. So as an example, if we look at plugging in the basis and the salvage, the basis is 900,000, salvage is 70,000, so the differential there is going to be 830,000. And then if we look at the total lifetime production, it's expected to be 40,000. And we look at the very first year, we only produced 4,000 out of the total 40,000 it's expected to be used for. So in this case, we get to depreciate 10% of the differential between the basis and the salvage. So the differential there was 830,000. We get to take off 10% of that. So we get an $83,000 deduction. Similarly, if you apply that to all of the other years, in the second year you saw twice that, so you get a $166,000 deduction. In the third year it was twice that much, so you get $332,000, and then it wanes back in year 4 and 5 to familiar numbers that we saw in the first couple of years. All total, our unit of production depreciation does depreciate $830,000, so that does get you down to the $70,000 salvage value that you expect. Now, I am not going to lecture on the remaining material that's in here. If you're interested in that, there's information on what's known as depletion. That is in your Chapter 11, but I'm not going to evaluate you on that. I'm not going to test you on that. So I will stop here. I encourage you to read through the chapter and to figure out as much as you can about this, but this will not be on the final exam, whereas depreciation will be.